What on earth has happened to NIO? The once famed Tesla killer has now foreshadowed itself in the global race against internal combustion engines as it struggles to increase delivery count and compete with the highly sought after startup market of the Chinese mainland. NIO was and still is one of the most heavy retail investor focused stocks in the electric vehicle space, as its shares skyrocketed by more than 500% during the pandemic following the EV craze cycle we all witnessed. But now that markets and investors have cooled off and the reality of fierce pricing competition is starting to hit the income statements of most new startups, NIO seems to be the one that is underperforming the most, at least in China right now. Why exactly has this happened, and what can the company do to rectify it? Well, folks, those questions are exactly what we're going to try to address in this video. But as usual, folks, before we get into it, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. To start things off, folks, let's first put some perspective on NIO's business model and what role it plays in the EV space right now. As I'm sure many watching this video are familiar, NIO was certainly one of the pioneers, at least in the Chinese automotive market, for electric vehicles. Although BYD launched the very first and commercially available electric cars in mainland China, NIO happened to be one of the very first, focusing much more on innovation, efficiency, as well as scaling up into different car segments with its wide variety of vehicle offerings. And one of the key innovations the company developed was the idea behind battery swapping, where you would essentially have the whole battery unit underneath the vehicle replaced by an automated robot machine completely in-house. This would be obviously much faster than fast charging your vehicle, which even at around 300 kilowatts can take almost 30 minutes to go from 15% to 85% state of charge. This exciting outlook for the future allowed NIO to raise a lot of money after it started up from 2015 through to 2019, which is when the company decided to go public in the United States. At the time, this was certainly a really big deal because this was the very first time that a Chinese homegrown startup was going public in the eyes of American investors. And although recipients were extremely optimistic and positive at the very beginning of the IPO, shares of NIO tanked by more than 60%, nearing levels where many would have expected the company to go bankrupt. But NIO evaded bankruptcy in a shock result for most bears betting against the company. Using strategic capital allocation as well as raising money from strategic investors, the company was able to survive going into the 2020 pandemic. And since then, as we all know, history has a lot of stories to tell. In the pandemic, excitement for electric vehicle and clean energy companies skyrocketed. And any company that had anything to do with the industrial clean revolution was bound to be one of the most successful performers in the stock market. And being one of the best performers is exactly what NIO was, at least for a span of 12 months. Since then, shares of the company have tanked from almost $60 a share down to $7.75, and particularly over the past 6 months has significantly underperformed its Chinese EV counterparts by the likes of XPeng Motors and even Li Auto. And as we all know, markets always try to price in some sort of underperformance in the underlying business if the stock is underperforming in the short term. And at least from my research, there's at least a few things I can pinpoint for being the exact cause for why NIO is where it is today. And the very first point being the fact that NIO is generally using a very capital-intensive business model to build all the products it is planning to build in 2023 and 2024. Not only is the company, first of all, contract manufacturing out their assembly for the vehicles to a company by the name of JAC, which naturally reduces the company's profit margins and makes it much harder for the company to commission new products and designs to a separate manufacturer, but it also restricts the company from pursuing the innovations in efficiency, manufacturing processes, as well as general electric vehicle safety standards that it certainly wants to aspire to. With these small drawbacks compared to the likes of XPeng, Tesla, Li Auto are resulting in is a much more financial stricken position for the company, as it has more debt on the balance sheet, has compressed margins because of the price cuts that have happened this year, as well as the insane overhead the company has from the NIO house to the battery swapping stations to the more than 5,000 employees the company has worldwide. And as you can see, this financial distress came at a time when NIO stock was at a time much more overvalued on a price to sales and a price to book basis than its nearest competitors, especially given the very high debt levels the company has compared to its actual equity. As a matter of fact, XPeng, which had struggled significantly over the past 12 to 18 months to grow its own deliveries, recently surpassed NIO in insurance registrations from November 27th to December 3rd, and essentially matched the company's monthly delivery output to almost 20K for the full month of November. And yet another thing slowing down the adoption and growth of NIO has been its foreign investments in Europe, which has been one of the fastest growing EV spaces outside of China, where yet again it is getting outcompeted, at least right now, against Nissan, XPeng Motors, and BYD, with market share of its newly announced ES8 only sitting at 4.8%. Whether this be an issue with pricing, a lack of enough compelling features, or actual issues with logistics and supply chain, it is up to NIO to decide exactly what the case is. However, folks, just like the story for many distressed companies in the stock market, all hope is not lost for NIO as well as its brand image. Because recently we just learned that NIO is actually buying into its JAC contract manufacturing contract, and it is officially launching a new higher end product at its NIO Day at the end of this month. Not to mention the fact that the company is officially planning to spin off its battery production unit into a completely separate company by the end of this year, which is a very similar strategy that Alibaba followed throughout the China tech crackdown to avoid maximizing shareholder loss. Because now if you have a separate business unit for battery, that can allow different types of investors to support that kind of business separately without having to own portion of the NIO business if they choose not to do so. And since NIO already has a significant edge in the development of high-performance battery systems for motorsport applications like we've seen with the EP9, which broke EV track records at something like the Circuit of the Americas, and their custom-built Formula E team, which happens to be one of the only for Chinese EV automakers, they certainly have a significant edge to play in this area, and their spin-off could certainly be one of the more successful ones in this industry. All in all, these factors come together to make NIO a compelling case for being down but not out in this competitive Chinese EV race. But as usual, folks, let me know your thoughts on NIO's situation down in the comment section below. Thank you very much for watching, and I'll catch you guys in the next one. Take care.